just fell. Then we realized that most of the years leading up to 2008, American corporates were taking more space on lease than the Indian corporates. And that's why the US economy is much more important on the office than actually the Indian economy. Now, if the US economy gets hurt through this crisis, there's definitely going to be pain that we're going to see on the office side. We'll give you some data, which is where our thought is. And that data is also backed by the survey where we surveyed the top 5 office developers and private equity in India who are operating, and the top 5 corporate occupiers. And understood from them is that what is their thought of going forward in terms of the expansion. The hurt may not come immediately. And even in 2008, it came really in March 2009. All this happened in 2008, September. And the reason is, first they really sort out their own home, their own employees, their clients, consolidation of the space in their own home country. Then they start to look at, what's happening elsewhere and where they can consolidate. We think is on the office this year, before COVID, 42 million square feet was going to get leased. Last year was 40 million square feet. So it was a fantastic year for the office. We think is that in base case, it may come down to 35 million square feet. And in a more worst case, if US economy does get hit badly, it'll be 28 million square feet. So that 42 may get reduced to 28 million square feet. I think, and if you can call it the good news or balancing news, is that even your supply is going to get constrained because a lot of it was going to get delivered this year because of the supply chain problem and labor problem and building factories in India not starting. That itself, which was going to be 47 million square feet, in base case, we're saying it'll be 40 million. And in a downside case, it'll be 33 million square feet. When we've spoken with the occupiers and the developers, they've said is that the soft commitment, the hard commitment that the occupiers had given, they're coming back to us and saying is we're not going to go ahead with that expansion. So if you can find an alternate client occupier, please go ahead and lease it out to them. I'll also cover one aspect in the commercial, which is what happens to the rent during the lockdown period. So many of the occupiers have sent notices to the developers to say is that during the lockdown period, we're not going to pay you rent. The developers have reacted in 3 different ways. One saying is that your servers are in our office, they are operational, your people are using the server, they're operating from home, why will you not pay us the rent? Second, many of the large private equity, Pratik, did not actually have a force majeure clause only in their lease. This we discovered it now when the private equity came in that, how can he say is because we never put up force majeure only in our leases, in majority of their leases, where I think the tenant really pushed, they had to, but majority of their leases, they did not have a force majeure clause. The third is that the verdict is still out, whether this is going to be considered as a force majeure or not. The lawyers are debating it, whether it's a national calamity and the government is, putting it up, force majeure. There's been a lot that's been roaming around on the WhatsApp, but even till now, there is no clarity if it is or if it isn't. So we do feel is that it'll get damaged, but perhaps, Pratik, it'll be the least damage. The most damage will be the second one that I'm going to come to, even more than residential, is the retail. That, to our mind, it was the first one that got closed. Mall was the first one. It'll be probably the last one, Pratik, that will open up. When it opens up, the theater will not open, the food court will not open, the restaurants would not open. There'll be social distancing norms in there. And we're getting reports from China that, people are coming into the malls, but they are only coming to buy essentials, not discretionary, not premium, not luxury products. So we think it is going to take time for it to build up. This year, at the beginning of this year, we thought new leasing of 62 lakh square feet was going to happen. We think in base case, it will go down to 43 lakh. In worst case, it may be just 50% of that, which is about 31 lakh square feet. I'll say 4 or 5 things in this one. The Retailers Association of India has said this, that if the developers don't help us during this period, on rentals. And if the government does not help us, 30% of our members will not be able to go through this. And I spoke to the chairman of the Retailers Association of India, and I said, really, you are so thinly capitalized that, say a month and a half or 2 months of rent, and you're saying 30% of your occupiers are going to go out of business. He said, no, Anuj, it is not about the rent. It's about a merchandise which is in the store. That merchandise is going to go out of fashion now because the season will change. And hence we'll have to send it out at a discount. Who's going to bear that cost? So the discussion that is now going on with the developers and the retailers is retailers saying there's no question that we're going to pay you during the lockdown. That, by the way, majority of the developers have agreed as well. So contrary to the office. What the question is now is that after the lockdown opens and your mall opens, we will still not be able to pay you for the next 9 months, because the retailers believe that it will be only gradually that the people will start to come back, if they ever were to come back, given if, the vaccine was to come in there. They're saying is, however, we'll pay you a percentage of turnover. Whatever, turnover we do, depending on the category, we'll pay you a percentage of turnover, but we're not going to pay you a fixed rent. Now, the trouble is that the mall owners have largely taken LRDs from the banks. So they are saying is, well, actually the rent that you were paying was not anyway coming to us. It was going to the bank. And the bank is going to start calling this a default, because if you're saying till 9 months, you're not going to be able to pay the rent, and certainly the revenue share that is going to come in will not come up to the rent. We think it will be probably 25% in the first quarter, 50% in the next quarter, 75% in the next quarter, and then it will come up to 100%. So, that dialogue is going on between the two of them to say, how do we really cover this up? The third, and why I'm putting this out there is because there will be now opportunities that will start to come up, certainly for the HNIs in there. Many of the, crown jewels of a number of developers will come out into the market, certainly on the office space, I think, Prateek, to be able to buy at perhaps more attractive yields than what it was before we went into COVID-19. But let me just cover quickly on the Resi. I think this, as you rightly said, is, Mr. Parekh's webinar yesterday. Clearly, he said is that do whatever is required to do to go out and sell in there. We think it is going to be very tough for a weak developer, a developer who's relatively unknown, to go out and sell, because a lot of this is going to be lockdown, open, lockdown, open. One of the stronger developers said is that I may actually not want my buyer to come at the construction site. What if the buyer has a virus? And, he contaminates my construction site and I'll have to get quarantined in this entire thing. We had, as it is, the space was getting consolidated. I mean, a lot of these developers had started to go out of business. We thought, it would have been another 18, 24 months when it would have been fully consolidated. We think that's now 4 to 6 months. And that is how, quick this consolidation is going to be. In terms of the sale, I think we're still being optimistic a little bit. And I'll explain you 2 reasons. One is our survey. And the second is we do believe is that property prices, certainly on the completed units, will get corrected. And hence it'll become more attractive. So we think is that in the, again, Prateek, I'll just for the reference of the full audience, and you're perhaps more aware of it. In India, in 2013, in the top 8 cities, we used to sell 550,000 homes, or we call it as units, 550,000. I mean, 2013 at sort of midnight, if you were to wake me up and say, where's going to be India in terms of sales, I would have said is, at least 1 million, 1.1 million. India doubles every 5 years, and 5.5 lakh would have gone to a 1.1 million, 11 lakh. We've actually come the wrong way. So that 5.5 lakh in 2013 actually came down to 2,60,000 units, which is what we were projecting the sale to be this year. We're saying is in a more sort of, optimistic scenario, at least 1 quarter sale is gone. So that's 25%. We think is that it may get further hurt, and it could be as much as 35 to 40%. So that 2,60,000 can come down to 1,96,000 or 1,70,000. And this is also, Prateek, putting in an asterisk that blue collar or the affordable housing jobs in that sector, the informal economy and the sector, does not go away. If those go away, then we don't know what the number would be, because a lot of this number is coming in from the affordable housing. Also, when we did the survey, there was a positive thought as well to say is that I invested in stocks and mutual funds, and I wish I had invested in real estate. My parents have been saying, my spouse has been saying, in circumstances like these, I wish I had real estate. Also in survey, Pune and Bangalore, I think flat owners or landlords have really misbehaved with the tenants. The building societies have misbehaved. They have differentiated between a tenant and a flat owner, that you can go, you can't go, you're going to contaminate our building, etc. So there is a sentiment that they may want to buy. In preparation of this, we got in the data from China, which has come in, and they're saying is that that in the just leading up to this crisis, China used to sell 5,000 homes a day just before December 2019. And this is a company called as Capital Economics, which is not owned by the government. So just before December 2019, in the top 30 cities, 5,000 homes a day. They came down to zero. March 2020, they have gone to 3,000 homes a day. So 60%. So who knows? I mean, like they're saying is that car sales have dramatically increased because people want to avoid, taking public transportation or shared transportation. So we don't know which side it is going to come in. Now, I'll just end on where our thought is on this consolidation, funding, financing, and where the opportunities, and where one has to be also cautious for the people on the screen. So clearly, financing is going to become, funding is going to become difficult because a lot of their dependency was on the sale. And, we've started to do this online. We're telling you it is starting to work. For the 4 developers that we are doing, it has done pretty well. But these are big names, and they've been able to do it. I don't think we'll be able to do it for smaller names. So as it is, they were getting hurt, Pratik. In this process, they'll get further hurt. Our survey, when we did, there were 3 or 4 things that came out which will further hurt these guys. One is that the home buyer said is, look, certainly I'm not going to give my next installment. These are of the houses that were already sold. Because once this lockdown opens, I want to go to the construction site and see is whether the guy is going to start the construction or not. Plus, I also want to see whether I have a job or not. So I'm also going to tell my bank that please hold the next installment for it is, which will create a huge amount of pressure on the cash flow because these were like committed payments that were going to get in. Second, they're very clear is that we're not going to buy from a tier 2 developer unless we see the construction activity already ongoing. Third, there's a huge amount of emphasis on the product that they want. It's a different product that they want. The quality of the product they want differently in there. Interestingly, NRI inquiry has improved, but still it is not significant for these guys to be able to go through it. So I think the opportunity will arise is on some of these developers where they're nearing completion. They may need the last mile funding because their existing lenders, Pratik, may not be able to really give that additional. So it will be like a LIFO, last in, first out, fully covered, and the money only goes towards the construction and completion of the project, and the developer gives you whatever the interest is. By the way, the government of India has come out with this fund called as Swami Fund, and they're following this only. There's about 13,000-14,000 crores that they have put along with some of the other investors in that, and following the same process.
They're only targeting the affordable out there, right? I mean, they have a 2 crore cap for Bombay and 1 crore for other cities. So yes, it's limited in that sense.
It's limited in that sense. So there will be categories, above that one. And Pratik, also they're very regimental in what the things need to meet. There's very little flexibility. So there will be opportunities where, you can't go to the Swami Fund. And hence, it could be there. The second is, Pratik, at this moment in time, what will sell is largely office spaces on, income producing assets. Many of the developers had held that these were family jewels. We're not going to sell this. ever. I mean, you're aware, we did that one BKC transaction. It was that we were not going to do it, and this is pre-COVID. I think post-COVID, you will start to see many of these opportunities which were going to be family jewels. They were not going to sell it, but because there is so much of pain that has come in a business that they're not expected the pain to come in, they may start to sell that for attractive yields, the office space. Whilst office will get hurt, but we think it is the minimum hurt that it is going to, and this may be an opportunity to do that. The third and the final one is the industrial. Why I said is that, it is starting to do well is, there are three things. One, e-commerce companies have come in a big way, and warehousing demand has just gone out of proportion in the last few weeks. Second is the data that is coming out from the US as well, confirms that the warehousing logistics will be here. The job losses, in fact, they're the only guys who are hiring at this moment in time. Third, this is anecdotal, but we also got some information which I'll read it out. Is that there is some negativity about China that is going on. I mean, look at Japan. They pulled out, or they've got this $2.2 billion of fund to pull out Japanese companies from China to relocate to Japan. Likewise, there are thoughts that Trump needs an enemy in this year, which is his election year. And that enemy is going to probably make China, as that is. So, this news item came in recently, which said about 200 US companies seeking to move manufacturing base from China. So, if India really comes out relatively unscathed through this, and the Indian government does a good job, we think is that, this sector can start to attract manufacturing outsourcing. Not that people are going to close factories in China, but the third or fourth factory that they were putting up in China, they may start to explore Vietnam, Indonesia types, or India. And that's where we think is that this may be an interesting asset class that, some of the people across the board may want to look at it. At this stage, I'm going to hand it over to Amit, Prateek, if it's okay, or back to you, whatever you want.
Sure. So, I'll invite in Amit right now. Just wanted to summarize. So, Anuj, basically what you said is there are three broad areas of opportunities which you see today. One is the last mile funding, where, some of those debt structures, but much better than the FSI debt structures, which used to be there in the earlier days, where you were basically selling air out there with land, trying to fund. But this is really where projects are 80-90% up out there, and you're looking at last mile funding. So what type of debt structures which could come in there? The second, of course, you're talking about attractiveness in commercial. And, I was having this chat with Anuj in so many years, after 2 decades in banking and things like that. There are very few times we've seen positive carry today, right? I mean, if you right. actually can see distressed transactions, and Amit and I, we were discussing the other day, saying that, if there is a 9 to 10% type of a yield on distressed commercial, which can be achieved for some type of assets. I mean, it may still be in that 8 to 10% range, but, if let's say you can look at some of those type of things, SBI MCLR, which is down to now 7.75, right? LRD rates could be very attractive for the HNI clientele segment, which is there. The opportunity to actually have a positive carry on good quality commercial office space is not been there in a long time. I mean, maybe 2003, but post that we haven't seen that type of a positive carry. So, to the point which you made on commercial, I think there could be some interesting transactions which could originate in that area.
And then Prateek, so beautifully summarized. And it is, I can't remember, when it was positive carry, but, it may have been well over 15 years ago that it is a positive carry. And what is also going to be interesting is, we think that the home loan rates will also probably come down to about 14-15-year low, because, they're at about 7.5%, which we think in the next few weeks, the home loan will be at. That Prateek was 2004 to 6.
Yeah.
So, really everything that you're taking back now, the only thing is you have to be sure is that how you're pricing the risk in this, on the office, perhaps there's very little risk other than the occupier leaving. On the first one that we discussed, Prateek, maybe there is a more risk because it's construction, linked risk with the developer. So I think we'll discuss that more as we go on.
And the third one, of course, you talked about the whole warehousing, industrial parks, and some of those type of opportunity which is there. Some of the questions which are coming in, Anuj, also want people want to understand on the residential side, right? I mean, we've had a lot of people. I mean, I know while there is a clamor on affordable, and that is an investment product which people look at. But people who are end users who've looked at upgrading residential. I mean, I remember reading in your report that you have 6.4 lakh units inventory unsold in the top 7 cities, right? do, I mean, what's really the end user led demand, and reasonable pricing? I mean, I know you referred to the consolidation which may happen. I still remember when RERA had been launched, you had made this statement at that time, right, 4 years back, that you will find 80 to 85% of developers going out of business. And I remember people were saying, has Anuj lost it?
Right.
Right? But I mean, you called it because there are structural issues in this industry, right? It's very fragmented, and it's not. So while you can try reviving parts of it, but there has to be that consolidation, and that may also lead to some sort of price discovery. How do you, I mean, are there some indications you can give around how is the end user led demand, both even on the mid and high segment? Are there deals to be made out there?
Yeah. So I'll answer it in two parts. One is on the consolidation. So Pratik, you're absolutely right. At the time of RERA demonetization, we said is that 8 on 10 developers will get out of business. And we think probably 6 on 10 have already gone out of business, by the way. And there is 2 on 10 are left, which we thought would have taken another 18 months for them to go, which we're now saying is probably 4 to 6 months now. And it is just going to speed up this entire thing. And then, on the other side, it will be a much cleaner environment. And, a lot of people criticize, but, if you come out with the facts, so, like India, we're selling, say, 250,000 units a year. There are 22,000 developers who are selling 250,000 units. I mean, that's like 10 units a year that a developer on an average is selling. I mean, there's no need for so many developers to be there. China has 1,000 developers and they sell 1 crore units in there is, and we've got 22,000 developers and selling, say, 250,000 units. So, that math will just not stack up. Even if 80% was to disappear, Pratik, we still have a huge, large number to be able to, cope up with what the demand is.
So, Amit, sorry, just here, Anuj, if I'm interrupting, and there was a specific question around this. What do you think is the right price? When does one actually go and buy? How do you really look at, and we're not talking about development risk out here. We're talking about, let's say, if somebody is negotiating unsold inventory today, how does one go about that? Is it 3 months, 6 months, 1 year? What does one do really?
So Pratik, absolutely. And that's the second part. So I would say there's 50,800 crores of completed inventory, which is where the maximum pain is going to be of the developer. This is sort of completed and unsold with the developer, and there's no risk on this. This is the inventory that one can get the best discount at. If there is, Deepak Parekh said there's 20% on this. I think today it will depend on the developer to developer, and if he sees color of money privately, he will be willing to do a deal. Is there going to be pain? Across the board, it will be pain. Whether you have a hotel, which is now shut, whether it's a mall, which is now shut, whether it's an office, that onslaught is going to come to you is. So previously, these three were annuity incomes. And hence, even if Resi wasn't doing well, you had other areas from where you were going to be able to do it. So at this moment in time, for the developer, there are those three areas. So this is the only one. So there will definitely be a lot of deals that they will do. I would say is, it depends on the financial capability and capacity of the developer. There'll be lots of strong developers. They will not cut down the price in there is, Pratik, because that is what it is. They have an ability to withstand the pain for the next 12 months.
I know in that same webinar yesterday, he also referred to, for example, Vicky Oberoi and say, you got a great balance sheet. You don't need to do anything type of a thing. You're going to sit over it, right? So he did make that difference when he was talking to different people out there.
Yeah, that's right. Or a Reheja or a Vicky, or a DLF. Unlikely that they're going to bring down the prices in there. But there will be a lot of deals that you will be able to do it depending on, what is the extent of pain on the counterparty with whom you are really dealing. So very difficult to say. on a broad basis. But, as a thumb rule, Mr. Parekh said about 20%. So that is what I would say would be applicable as a discount. But it'll depend on developer to developer. Some of the stronger ones will not. Some of the weaker ones may even give you more.
Sure. Great. So Amit, I'm going to bring you in on this because, since we have been discussing the alternate asset businesses, right? I mean, we've been talking about co-living, student housing, co-working. What do of course, y'all were very closely involved on the embassy REIT side and some of these, rent yielding assets which were there. So there are two parts to this question. One, what is the expected impact on companies like DLF, embassy, which were dependent on rental income? And second, what is really the impact on the new age businesses like co-living, student housing? I mean, again, as you've been speaking to people, on one side, the same thing they said, co-living may actually do much better. But on the other side, they said people now want privacy. So is there, again, some initial indications from China or things like that?
Yeah, I can take the second one. Let Amit do the first one. And then Pratik, I'll take the co-living, co-working question. Go ahead, Amit.
On the first one, Anuj is obviously conflicted. He's on the board of embassy REIT. So I'm sure he will try to stay on mute on that. So certainly look, in terms of the way this issue has got priced from how it behaved from the offer price and now, and I'm sure everybody has tracked the price movement, but for the interest of all, it got listed at price of 300, went to a peak of about 500 plus, has got back to about 380 levels right now while we are talking. So certainly the impact of re-rating of the rentals is quite reflective in the price right now, right? And though obviously it has to be still seen that how much of impact it will have on the net operating income of the platform. And look, I will really stay away on commenting on that because I've always said that Anuj is on the platform, so we'll stay away on renting. But I think what I will firmly stick out when Nick can say that even in current market valuation and go and align it with what's happening on the unlisted commercial yielding space, the positive carry between what's happening in interest rate and the funding rate of the LRD makes it a compelling argument. That's one. Secondly, obviously, historically, we've seen this positive spread from a FPI or a foreign investor standpoint. And for the first time, we are saying that the onshore investor themselves have a positive carry. So that makes a compelling argument. So the second point to my mind completely comes is that, look, at this point of time, makes more sense to play Ray stocks, which are in major micro markets, obviously, and along with embassy REITs as well. I'm not putting out my neck and saying it's a buy recommendation on that. Please don't take that. And I'm sure I'll leave that to Pratik for you to go and comment. But I think certainly from the way the rates are going to get panned out and the way the supply and demand will go and match. And obviously supply will come down as Anuj has appropriately highlighted and demand will get moderated. But if actually anybody has a view of over the next 3 years, and I'm sure at that point of time, the operating income should get stabilized. That's a point when you start making great money on asset classes like this. And assuming that, look, the interest rate is coming off as well. So in terms of other investment opportunities that investors have, namely a debt fund or a bank deposit, or I'll just go and compare it with a 10-year GSEC for the sake of simplicity. Look, if the 10-year GSEC is currently at 6.5 right now and expected to go down to about sub 6 or closer to 5.5 as interest rate will come down, the positive impact also of that will be seen on the REITs or commercial yielding asset classes as of now as well. And that is where I think, to my mind, comes a point that you need to strike a balance at what time you need to enter the market. If you wait too long, and the spread between the other investment opportunities in the fixed income space and the commercial yielding asset and REITs gets too stretched, and I think you'll see a big rally happening. Because as we've always seen, the market goes and prices what we expect in future, right? So in that sense, I'll just take in case in point of embassy REITs here. If investors want to wait for longer, in my view, look, it's currently assuming the same kind of NOI which was gone and predicted. You are actually think anywhere between a cap of the dividend income or the income stream from that platform is anywhere closer to 7% right now. And if it is currently at 7% and the NOI will get further moderated, the yields are bound to improve on that, right? So I think just keep that in mind. And I'll hand it over back to Anuj now for the other part of the performance.
If I can,
Amit, maybe just complete that stream of that thought of discussions. I mean, I remember, when both of us were in HSBC, there was a time when we used to look at these FCNR deposits and used to wonder why is it that the NRIs make all the money, right? They have this carry and it's a leverage trade. And it just appeared so amazing, right? It almost appeared like risk-free money, which was there. So I think what we're talking right now is pretty much equivalent of that. Are there specific micro markets where you think, is it the same Bombay, Bangalore, parts of NCR, Hyderabad, Pune? Is that what it is? I mean, is there some preferences which you would have on when you talk about these asset classes?
Yeah, sure. I think it's a great observation which you have, and I think I should have highlighted that, and I'm glad you brought that up as well. See, certainly, look, the straight analogy is that just play with large micro market, non-IT in the first phase, and to our mind, when we are talking about from a supply standpoint, look, it's historically the supply was constrained, and as Anuj rightly actually pointed out that look, in the current market environment, the supply is bound to increase because a lot of developers will come and go and sell. In this environment, to our mind, obviously, stay in very grade A micro market like Bangalore, Kurla, for example, where you're not playing too much of non-IT actually occupiers, because non-IT at some point in time can get actually repriced. And obviously, to our mind, Pune is still a buy. Not for a moment, I believe that Pune is not. But in Pune, the way to play it is that instead of going for a strata, it makes more sense to go and play independent assets there. So I think in larger markets like Bombay and Bangalore, you should play strata, and I think you should play more of front offices in this environment than on back offices, because front offices will continue to have actually existence. And if there's a change in terms of behavioral change where you see that work from home will increase, that will more impact the back offices and the IT than instead of front offices. So the way to play it out is just stay in grade A, stay in major large micro markets where you don't see too much of impact of the behavioral change, which we still need to see how it impacts the market, especially on the occupier side, and actually stay there.
Thanks, Amit. Thanks for the insight. Sorry, to the second part.
Yeah. And Pratik, if I can just take sort of 10 seconds on that one is, I mean, some of these private equity did not have a force majeure clause. So, even if the rentals were to, go down in force majeure, they'll not be able to take protection. The occupier will not be able to take protection under that. And, unlike retail, where, it is the spirit that defines what's written in the agreement. Here, usually the corporate occupiers in the past also I've seen, stick to whatever the agreement is. The agreement says what it is, then they'll follow that. IBM, Accenture, unlikely that they're going to, default on what's written in the agreement. Some of the retailers will, because, that is how, those two markets are. The second I would say is, Pratik, is that when you're buying physical, go and meet up with the tenant. Have a word with him and say, look, I'm likely to buy it. Do you have any thoughts of, either consolidating your space or exiting? Have that conversation with those guys. Just coming back on to Pratik, the question that you asked, fundamentally, I remain very positive of that business. I think, all Amit, Shobit and I believe that, it is a sharing economy. It's the sharing of the asset, and hence you're sweating it out more, whether it's co-living or co-working. We have 4 things at this moment in time that really worries us, and, hopefully this will go away. Just like Ola and Uber, many people will not sit in those after the lockdown opens up. And, in fact, we got the data from China, and they're saying is that the car sales have gone up by 48% because people want to avoid public transport. Soon after the lockdown. Similarly, we think is that, in some of these co-living, co-working, Pratik, that some of the people may be like concerned, who's sitting next to me? I don't know, what's his hygiene background? Where does he come from? In office that I go to, your office, Sanctum, I know who's who. Your people know who's who is. So that's the first thing, that how do you make sure that you're sanitizing in there is. The second is that we believe is that in this crisis, it is not going to be about traditional economics on the other side when we come out. It is going to be about design. It's going to be about psychologists leading it, sociologists leading it. It's going to be different, and this is what's coming out of the US as well. So we think is that one of the things will come out will be is that in the offices, density norms will come in. Today they have very dense offices, 50, 60 square feet per person that they are doing it. And that is how the co-working guys are sweating out the assets. Now, if the density norm changes, then the business model may change for both co-living and co-working. The third one is, many of them are not in profit, and they're being funded by private equity. Some of the private equity will continue to fund it. Some of them may not fund it. So, what happens in those circumstances? I mean, we saw that SoftBank pulled out, last week. Yeah, and the last one that I would say is that, occupiers were usually startups who were waiting for private equity to be funded, unlikely in these markets that a great idea may get funding. And larger corporate occupiers who, as an option, will find this is the first place to exit because it's the most flexible to do it rather than trying to break your lease. Here, you've not spent anything on the fit out. So the large occupiers, if they have to contract, this is the first one that they will contract on. And then the small startups may just find it difficult to be able to continue given the environment that they'll not be able to raise equity.
Right. What about the co-living in student housing? One of the comments here is that maybe people out there may actually do differentiated design, single occupancies. Maybe the economics may change a little bit out there. But, with that whole millennial, and the demographics haven't changed, right, Anuj, because of this. I mean, we still have that young population. We still have the people. I mean, if anything else, I think, people have realized that you may want to be closer a little bit to your workplaces and things like that. So some of those demand factors may still be around, which is there. I don't think as much as people may talk about e-education, our universities are not going to be shutting down, right? That is traditionally an Indian parent still would want to send the kids to college out there. So some of those factors for pull from a demand side does continue, right? Would you agree to that?
Yes, I completely agree, Pratik. Demand is not going anywhere. I think those guys who are able to sanitize it and bring down the density norms in their areas and make sure, there is social distancing because, this thing isn't really going away. Vaccine will come, hopefully, beginning of next year and, we'll be okay. But I think, somewhere it is going to get ingrained in our minds now. And that's what they're saying is, it's not going to be a new normal. There's no word normal only now. It's going to be like a new world on the other side. And, many instances have been given. World War II, prior to that, women weren't in the workforce. Men died or they were busy fighting. Women came in. In SARS, Alibaba came in 9/11, security companies came in. And like this, in this one, they feel is that it is going to be a lot about the design and psychology and sociology of the public, given it is all health related on this occasion.
Right. So, I think we just in the last 5 or 10 minutes, I just had this one, client who asked this, if an allocation has to be made to real estate today, what would be the option? Would it be the yielding options? Would it be greenfield, farmhouses, residential flats at low valuation, commercial properties? How does one really make? So, we've traditionally all, most of us who've been part of wealth management have always talked about financial products, right? And as you rightly said, one of the points is that people are looking at real estate a lot more strategically now as an integral part of their asset allocation, as part of their financial portfolios. Amit did talk about REITs and, that being one of the options which are coming. We're talking about creating similar type of financial options. How does one make, a portfolio? How does one do the assessment around that? What would be some of the things which people should look in this post-COVID world?
Amit, do you want to take it and then I'll add?
Yeah, sure, Anand. So it's a great point, actually again, Pratik. So look, from our viewpoint and the way Indians and Asians have behaved, real estate had always been core and strategic to a portfolio. And I think we all have, I can believe that, our fathers and mothers have always said the first thing you've made money is that go and buy a house, right? So actually other than a car. So I think, you're completely right in saying that, look, it's becoming actually far more important and core. Look, in an environment like this where obviously the valuation has got all corrected. We firmly believe that a large part of the allocation, and I'm not sticking out numbers, but look, if somebody has got $100 to invest, perhaps 30 to 40 rupees should go into right now on yielding assets, right? And clearly we've said that in that yielding space makes more sense to do grade A and major micro markets and stay away from actually ancillary and periphery and actually SBDs as well. And the balance about 30-40% should go into credit strategies. In credit, obviously, we've said that, look, last in and first out is a great example in terms of going and playing the market. Institutionally also, as Anuj highlighted, actually SBI is already on that strategy. So that endorses our view as well that from institution standpoint, the boys are moving first. And while we are talking, we are seeing more of institutional player joining the same kind of actually asset space. We've already seen about, to our mind, in the last 4 to 5 days, we've seen about 8 or 9 large actually FI investors who are already invested in India going and chasing the same strategy now. So clearly that endorses the view that the institutional part of the money is also flowing the same strategy. So again, just to, in the interest of all, we are talking about last mile funding in residential, large micro markets again, where you see continuing of demand. There might be some blip in the interim, but I'm sure we believe that's going to come back as well. Last in, first out, structured in form of debt. That still makes a compelling argument. Last and not the least, we also believe that completed inventory buyout, that is something which makes sense in this environment. Actually, always it has been, I won't say that the valuation has come closer to a replacement cost, but the way the market is getting priced and assuming that actually what Anuj and Mr. Parekh said some time back, if $100 is now valued at 80 and you create a payment plan around that, then obviously the IRR will go and increase in that. And we've always seen when you bought at time when the valuation or rock bottom, you're bound to make money from that point of time if you have the ability to hold. One more asset class I like to highlight, and in that context, affordable also comes in play. And I think investors will have that opportunity to go and play either directly or indirectly. Is that, look, acquisition funding for grade A guys, especially at this point of time, if somebody who's a grade A developer and he's looking to acquire a land or he's looking to get into development, actually acquisition funding at that point of time also makes sense. Because if somebody is launching in a market environment like this, where the costs are getting optimized, the commodity prices have crashed, the interest rate has crashed. So obviously from a new development, actually arithmetic, it makes a compelling case again. So these are the 4 transaction types where we believe, or the asset types where we believe. And I think I will leave the individual asset allocation to someone like you, who's obviously a portfolio advisor, to see that, depending on the risk profile of the customer, you say how much to allocate on.
Yeah. So I would say, Pratik, many guys have been light on real estate, in the last few years. I think it may be a good opportunity to look at real estate. However, I'll put a big asterisk. Look, make sure that you are understanding the risk properly. These are also uncertain times in there. So, this has to be, it's a risky asset class in there. Whom are you backing? What are you backing for? What are you getting in turn? I think there has to be, full, well thought out. Don't hurry into doing it because it looks very attractive. Many things will be attractive in that. Is just price. Yeah, and Pratik, it's a nice word to use, that price the risk. I'm not even saying is price the risk, because you'll get the price that you want. Is look at the risk, whether that's a risk which is digestible, whether we should take it or not take it. For example, office or listed entities in a couple of cases, that the risk is manageable. The 4th asset class, or the 4th opportunity that Amit said, will have a much higher risk, which is you're funding a developer for land acquisition. So I'm saying is just be very mindful. It is uncertain. None of us have lived through this either. So it's like in 100 years it's come like this. So we don't know what to do in this. But just make sure that you're understanding the risk, and you are best at it, Pratik.
Yeah. No, so we understand some of these things, Anuj. It's like when we talk to clients about investing in startups or private equity or angel fund versus buying an HDFC Bank or an Asian Paints or an HUL today, right? So the difference between what you would get is, and that's really the expectation on the IRR side also, which is there. So, I mean, we worked with Amit before, and it's it's very, very important to have that risk disclosure, and that's something I'm very sure most of our clients would want to understand. Anyway, I know that when I go to Amit with a proposal and I tell him this is 80, he ensures that it becomes, I get a transaction at 75. So in terms of him being able to negotiate that with a developer is always been the case. So I think those would be some of the opportunities. So really, summing it up, I think you've really given us a very good overview on the residential side. There are individual pockets which are going to be there in different cities, and if any of our clients have specific queries, right, on whether it is certain locations, certain projects, one of the areas which people have asked also about affordable and things like that. So I guess for specific cases, as I said, real estate is always a very, very it's, one doesn't even say local market, it is specific to developers, as you rightly said, and would be specific to locations and things like that. And I think this could be a very interesting opportunity for many people to evaluate those decisions around end buy, and whether it is a 20% haircut, or as I said, Amit's specialty to get a slightly larger haircut on those projects. We will, those are specific cases we will be able to discuss. On commercial, we do understand that, while there is a temporary challenge around how some of the office supply is going to take place. I mean, a lot of people are talking about work from home, and is it going to create a little bit of challenges in terms of the demand side actually, because the supply is already there. But I guess some of those factors will be taken into account when there is an investment proposition. But again, certain micro markets which Amit you were referring to, whether it was BKC, Pune, Bangalore, some IT, non-IT assets, I think could make for interesting opportunities. We did talk about the positive carry which is there, which is maybe once in a lifetime opportunity for many people. Interest rates are still expected to come off, and if you can get into longer term leases today, that could be a great option which is there. We spoke about opportunities on industrial and warehousing specifically, and I think the quality of tenants you get there, and again the type of leases with onshoring type of opportunities which may come in, that may be there. And again, on the debt side, last mile funding is another area which is there. Finally, Anuj, any last thoughts around this? There is, on the other side, there is this other thing, right? There's so much of uncertainty. There are job losses which are happening. While we may paint a side which may say that things could rebound, and China, we are already seeing some signs of it. There are limitations here, right? We've still not got the fiscal package, which a lot of people are saying. There are massive job losses expected. I mean, they're talking about at least 50 million job losses in India, which may happen. So, many of these things are going to also create some level of this thing. So, as final words, what is it that really, from one should play this out? How should one look at this? Anuj? You rightly said, it's once in 100-year event. Maybe after the 1930s, this is what we're facing right now. What's your final this thing on it, Anuj?
So Pratik, my final point is that there is going to be shortage of liquidity in the market. Liquidity is going to be even more difficult to be able to get on. I would say is look at the opportunity and ensure that is the best use of your money to be done. We live in this sector, so we know some of these opportunities. Certainly, on, like I said, is on the office space, maybe on the listed space. I mean, we inherently know that they are brilliant opportunities, and they're largely risk-free. In there is, and I would say just calculate, things where you are able to digest the risk, because as you rightly said, Pratik, none of us know where this is going to lead to, but there will be opportunities where the risk is manageable, and yet the returns are pretty decent, and that's where I will really veer to.
Okay. Just one final for my equity analysts out here. So they ask, is real estate company investing in a real estate stock better, or is it better to invest in a real estate asset right now?
Stock, clearly stock. I mean the inventory. I mean the physical asset. Sorry, not the listed stock. The physical asset. Absolutely.
Yeah, I mean, I completely concur with that. As we've been looking at most of these companies which are heavily leveraged, there could be one or two, okay opportunities, but the sector is ripe for consolidation. You're going to have buyouts happening out there. I think we would be very keen to look at, advising people on real estate assets rather than real estate stocks at this point of time. For a change, this is coming from somebody who runs a stockbroking license. So, but thank you very much for your time. Thanks, Amit, for your inputs on this. And as there are specific queries which come in, we would answer, and we would reach out to you for that. Again, thank you for taking this time, and thanks everyone else who joined the call out here. We are in this process of trying to get as many people from the industry to help us navigate this, interest, these times which are unprecedented, as Anuj said, once in 100 years. So we will keep this level, keep this engagements going on. Thank you.
Thank you very much, Prateek, and thanks to all the viewers.
Thanks.
Cheers. Stay safe.
Thank you so much.
Thank you.
Thank you so much, and stay safe, everyone.
Bye, Prateek.
Thank you.